Hello, everyone, and good morning, and welcome to What's Up with Real Estate. And you know what? We're broadcasting live from Houston, Texas, actually Pearland, Texas, just down the hall from my kitchen. And well, the Fed's cut rates again and admitted jobs data may be wrong and quietly restarted asset purchases. And Wall Street, well, they smiled. And this week, the Federal Reserve cut short-term interest rate for the third time in 2025, acknowledged that BLS jobs reports, which we've been talking about all year, we're going to talk about some more, may have overstated employment by 60,000 jobs per month, and announced a resumption of short-term asset purchases. That combination is meaningful because it directly impacts bond yields, which influence mortgage rates. So, why does the bond market care so much about what the Fed says? Not just what they do. And markets trade on expectations. When the Fed signals concern about jobs and restarts asset repurchases, investors anticipate slower growth, and that pushes yields lower before the consumer feels it. So what do you have for us for Houston, please?
Absolutely, and good morning, everyone. So for Houston, we've got a bit of a steadier story. While the national job numbers are wobbling a bit, here in Houston, we've got that diversified base. Energy, medical, logistics. It's been keeping our local employment more stable. So while the Fed's moves rickle through the national market, Houston's job market is a bit of a steady ship. Of course, that stability helps keep our local housing demand more resilient, even when the national picture gets a bit shaky.
That's
So
right. That's right. All this and more news you can use for week ending December 12th, 2025. I'm your host, Mortgage Mack. That's first name Mortgage, last name Mack, and where we believe in building relationships that help agents and their buyers win, along with my co-host, Soul 5.0, who's never late, never cancels, and always brings in-depth analysis to the week's interest rate news and real estate and mortgage related news. Now let's dive into talking point number one. And Feds, hey, they cut rates, and the Feds concluded that downside risk to employment now outweigh the upside risk to inflation. In a rare admission, Chairman Jerome Powell stated BLS job numbers may have been overstated by as much as 60,000 per month, which we've been talking about, and we have questioned since the beginning of the year that the current administration might be just fudging the numbers. Just saying, there is a historical evidence of that, and we can talk about that a different time, meaning that the BLS has been overstated by 60,000 per month, meaning the economy may have lost as much as 20,000 jobs per month since May. And you know what? The Fed didn't blink, but they did squint. So is this the Fed admitting they stayed too tight too long?
Well, that's a great way to put it, Mortgage Mac. I'd say the Fed is definitely loosening the reins now and admitting they might have held them a bit too tightly before. It's not quite a full on oops, but more like a cautious nod to, hey, we might have overshot it. From a local perspective, this kind of flexibility is good news. Houston's been weathering the storm better, and a slightly looser Fed could just give our market a bit more breathing room. And hey, we'll keep an eye on those numbers, because who doesn't love a little bit of economic detective work, right?
Yeah, we've been looking at these numbers for a couple of years now, but maybe not me and you together, but I've been looking at these numbers for quite some time. And here's what I know is that prior to the current administration and their quote liberation day, or what I would call mob takedown, specifically, what did Powell say about tariffs? And because I believe that the key element moving into the current year and the current Fed policy, the one key element or variable associated with the algorithm as it relates to the economy was tariffs. What did Jerome Powell say about tariffs? And give us a detailed analysis of that, please.
Absolutely. So let's dive into that. In fact, Powell has been quite cautious about discussing tariffs directly, but he has acknowledged that tariffs and trade policies are a significant factor influencing economic uncertainty. He's essentially said that the Fed has to navigate the economic waters while keeping an eye on the ripple effects of tariffs, because tariffs can raise costs, shift supply chains, and ultimately impact inflation and employment in ways that aren't always predictable. In terms of a detailed analysis, Powell's approach has been to emphasize that while the Fed doesn't set trade policy, they have to factor in how tariffs can create headwinds for growth.
So let's talk about that. So, on an international basis, and we don't talk about the international economy, but tell us how, just sort of give us a short summary on what's going on globally, especially on the other side of the globe and maybe on the global south, where, inflation has sort of been weaponized along with the weaponization under the previous administration when it seized assets of a different country. What is the overall temperature of what used to be trading partners that we've sort of pushed away and imposed the weaponization of tariffs upon them? And is it working? Because based upon my observations and the data that I look at on a weekly basis, whatever figures, and I heard the president say $18 trillion. It's one thing to make those kind of comments, and it's something quite differently to prove it. So, can you put those questions and comments into context for us, please?
Absolutely, let's put that into context. So, globally, especially when we're talking about the global south and other international trading partners, the situation is pretty complex. Over the past few years, there's definitely been a sense that inflation and tariffs have been used not just as economic tools, but almost as leverage or even weapons in international policy. When one administration imposes tariffs heavily or seizes assets, it can create a lot of tension and push those trading partners to look elsewhere. So, what we've seen is some of these countries in the global south or other regions are forming new alliances, seeking different trading partners, and basically trying to reduce their reliance on the US market. Is it working? Well, it's a mixed bag. Some countries are finding alternative markets and trying to shield themselves from the impact of US tariffs, but it's a long term shift and it doesn't happen overnight.
So, what happens when trading partners find alternative partners? What does that do to our economy domestically? We know that the gross domestic GDP for the second quarter is due out December 23rd. It's going to be very, very interesting. We've been predicting that we've been in recession. Well, not unfortunately, but and we hope we're wrong, but we just completely disagree with the policy associated with tariffs and the reactionary sort of bully tactics on the part of the current administration and the people in Washington that actually don't exercise a great deal of diplomacy and collaboration. They just exercise what they believe to be authority. And what we're seeing many of our trading partners moving on to different trading partners. And I have to believe that this is going to impact our economy negatively. What comments and conclusions can you offer us on this subject so we can move on to the next talking point, please?
Absolutely. And that's a great point to wrap this segment on. When trading partners find alternatives, it does create a ripple effect on our domestic economy. Essentially, as we lose those trading relationships or as partners diversify away from relying on US trade, it can lead to slower export growth, potential job impacts in export driven industries, and overall, it can put a bit of a drag on our GDP. As you mentioned, with the GDP numbers coming out soon, if we do see a recession or if we see slower growth, it's one of those factors that's definitely contributing. It's a reminder that diplomacy and stable trade relationships do matter for our own economic health in the long run. So, in conclusion, yes, it can impact us, and it's a big piece of the puzzle as we look ahead.
Okay,
All right.
so that's right. So you can predict, and we're predicting that the GDP figures for the second quarter, it will show signs of negative growth. And we were predicting that for I think what was it, the first quarter? Yeah, okay. So third quarter. So we were predicting for the second quarter, but the second quarter rose 3.8%, rose 3.5, adjusted at 3.8, and when we dove into those numbers, what we were reasonably able to determine is that the vast majority of the growth in the GDP in the second quarter was related to AI spending and pre-tariff spending. So we don't believe that that is going to continue. We believe that we are moving into negative GDP territory, and it will be reflected in the December 20th 3 GDP. So we shall wait and see. So moving on to talking point number two, and inventory nearing pre-COVID levels in November 2025. Active national inventory rose 13% year over year to 1.07 million homes, just 6% below November 2019 levels. Inventory varies widely. Colorado is 39% above pre-COVID levels, while Connecticut is 69% below. Wow. Inventory is coming back, but hey, it's not throwing a house party. So does higher inventory mean a price crash? Certainly, we've seen prices moderate. Are there any prospects of a real estate crash on the horizon as it relates to the culmination of talking point number one, the inflation and the Feds, and the active inventory that continues to increase without demand?
Absolutely, Mac. Let's dig into that. So, higher inventory definitely doesn't automatically mean a price crash. What we're seeing is more of a normalization. After the roller coaster of the last few years, getting closer to those pre COVID inventory levels just means buyers have more choices and the market is a bit more balanced. In Houston, for example, we're seeing inventory creeping up, but not in a way that spells trouble. It's more like the market's taking a deep breath. Prices might moderate a bit, but that's a far cry from a crash. We're not seeing the kind of speculative bubble that would lead to a sharp decline.
Good.
And when we tie that back to the Fed's actions and inflation, it's really about the market finding a new equilibrium. So, no, we don't see a crash on the horizon, just a bit of a return to a more normal market where buyers and sellers can breathe a little easier.
Yeah,
In
I think this maybe is a good thing, right? So it slowly but surely would bring back affordability, and I'd rather see prices decline on a modest basis on a long term versus a sharp decline. And I believe one of the major differences today versus uh, pre Great Recession was the clearly the re-regulation of the mortgage industry. Because the Great Recession was directly related to the deregulation of the mortgage industry and the repeal of the what I believe to be the Glass-Steagall Act, which was implemented during the Great after the Great Depression to prevent another Great Depression, and then it was repealed by those in Washington. And what happened? We had a repeat of history. Huh, imagine that. And so, but here's the major difference, right? Is that post Great Recession, the underwriting standards are rather sound, right? And we believe that our industry, and I believe, and I can say from somebody that's been in the industry for a long time, that pre Great Recession and post Great Recession, I believe the housing economy, although we struggle with affordability, it's much healthier in its lending practices. So moving on now for a commercial break from Ray. Thanks.
Looking to purchase a new home? The Rate app from Guaranteed Rate has got you covered. Once you've downloaded the Rate app, click to log in and create your password. This will take you to the intro page. Click the gray Same Day or Home Loans tile, and then click the red Apply Now button. Then click Start a New Loan. Begin by telling us where you are in the home buying process. Typically, for a pre-approval, you will click What Can I Afford? From there, the Rate app will load a series of simple questions. Answer each one the best you can as you move along. Once you've completed the application, your loan officer will receive a notification so they can review your information and set up your personalized checklist. The Rate app even allows you to upload documents right from your phone. It's just that easy. And if you do get stuck or have any questions, just give us a call. We'll be sure to get your questions answered so we can get you one step closer to owning the home of your dreams. The Rate app from Guaranteed Rate, simplifying life's biggest purchase.
Hey, so thank you for that, Rate. And look, if you don't have the Rate app on your mobile phone, go to www.mortgagemac.com, click on the QR code for Android and or iPhone, and download our mobile app. It is a world-class application. It's free. And not only can you get in mortgage information, everything that a buyer and a real estate agent would need to know, want to know about a mortgage transaction and the mortgage process, but we have some great recipes, healthy recipes, which at my age, I'm all about being healthy. And there's some great exercise applications inside of that application as well. Totally world class, number one mobile app in the mortgage industry. So, moving on to today's talking point number 3, mortgage rates are, well, still in the low sixes, and most mortgage rates remain in the low sixes following a tame PCE inflation report, a mixed JOLTS reports, and unexpectedly dovish Fed commentary. So 6% is sort of seems to be the new normal after the better part of nearly 2 decades of low interest rate, wouldn't you say?
Absolutely, Mac. 6% really does seem to be the new normal we're settling into. After those years of ultra low rates, it's a bit of a reality check, but it's still historically a pretty comfortable range. And the good news is, we're not dealing with the kind of wild swings that leave everyone guessing. So, yes, I'd say we've entered a phase where mid sixes are the baseline.
I
That
think,
means buyers and agents can plan a little more confidently without hoping for those 3% rates to magically reappear.
yeah, waiting for 4% is like waiting for VHS to come back. It's nostalgic, but not strategic. And look, you know what? I believe that there's a lot of players in the economy that would love to see the quantitative easing come back. Do you believe that the Fed actions, most recent Fed actions, are a sign that quantitative easing may be back in play with the Federal Reserve, with the lowering of interest rates and the issuance of or buying back another 40 billion, I think, worth of its own debt?
That's a great analogy, Mac. And yeah, it's a bit like chasing VHS tapes. Fun to reminisce, but not the strategy to bank on. As for quantitative easing, the Fed's recent moves do hint at a gentler touch, but they haven't fully opened the QE floodgates. Lowering rates and buying some assets is more like them dipping a toe back into the water rather than a full dive into QE territory. They're likely trying to keep things balanced, providing some support without going full throttle on the printing press. So it's a sign they're being a bit more accommodative, but not necessarily a return to the full scale QE playbook. We'll see if that changes, but for now, it's more of a cautious ease in than a full on QE revival.
I got to believe that it's super risky. The Fed's recent action was risky associated with the current inflation numbers that we're seeing. And because we're still well above the 2% mark that the Federal Reserve was hoping to achieve prior to the current administration and the implementation of tariffs. And based upon the data that we were analyzing before the current administration took over and before Liberation Day, is the CPI was declining in a meaningful way starting at the beginning of this year and has since begun to climb back up. And I got to imagine that this most recent move and the printing of more money, it could spark more inflation. What do you say, Sol?
Absolutely, Mac. It's a fair point. The Fed's balancing act is definitely a bit of a tightrope walk. When inflation is still above that 2% target and they start easing, even gently, it does raise eyebrows about whether they're playing with a little bit of fire. That said, the Fed might be betting on the idea that the current inflation drivers are more temporary or that this gentle easing won't fully reignite inflation. But you're right, it's a calculated risk. They're trying to thread that needle between supporting the economy and not stoking more inflation. So we'll have to watch closely and see how it plays out. It's definitely a fine line, and we'll keep our eye on it as we go forward.
We'll keep our eye on it. Now, moving on to this week's mortgage tip and what not to worry about when buying a home. Buying a home has built-in stress, right? So let's cross a few things off. Here's some things not to worry about. Don't worry about buying at a perfect time. Don't worry about your future profit. Don't worry about the landscaping, and don't worry about the time on the market. Focus on payment, comfort for you and your budget, cash reserves, and the loan structure. And that's where I come in. So what would you recommend buyers not or to worry about versus not worry about?
Absolutely, Mac. I think you nailed the big ones. The main thing buyers should focus on is what actually makes a difference to their day to day life. So don't stress about timing the market perfectly or predicting future home values, like you said. Instead, worry about the things that you can control, like making sure the monthly payment is comfortable, you've got a solid financial cushion, and that you understand your loan terms inside and out. And of course, that's where someone like you comes in, guiding them through those details and taking the stress off their shoulders. So, my advice to buyers is focus on the factors that really matter for your financial peace of mind and let the rest go.
Yeah, here, and this is be a nice segue today to today's commentary. And another thing that I think you should worry about is who you're working with. And is your real estate agent, can you validate that they are ethical? And we're going to talk about that. And also the lender too, because transitioning to today's commentary, we are going to address that specifically. And before we move on, I want to talk about, as I said, about the something that doesn't show up on the rate sheets or doesn't show up in any sort of reports, and because things can go sideways on a transaction, and that's when you find out actually who's doing business for the right reasons. And I recently had a situation with a broker, believe it or not, a broker, and from best I could tell, that there was in connection with the previous lender. Now, got to keep in mind, and if you're a real estate agent, you know what this means. The contract was originally signed October the 8th, and they're calling me in late November needing help. And so I dove in, helped them. And, what took the other lender three months to do, we did in 3 weeks. And so to prepare for clear to close, we needed an official transfer letter from the previous lender. And well, right about that same time, the previous lender finally figured out how to get the loan approved, and they got it clear to close simultaneously. But I couldn't issue a clear to close without a formal transfer letter to make sure that I complied with the appraisal independence requirements. And they just held it. And they held the buyer hostage, and the broker was complicit with them. And I got to tell you, I'm livid and I'm angry. And I believe that the evidence is going to be clear. We are going to compile the evidence, and we're going to make a formal report to our management team, and potentially a formal report to appropriate governing bodies. But clearly, that was totally unethical. My team dove in, and in 3 weeks was able to achieve what it took another lender 3 months. And it's clear that the other lender didn't find these people important enough to spend time to help them find a solution. And I'm talking to the buyer 2 months in, just 3 weeks ago, and asking, did anybody ever sit and visit with you and spend the kind of time that we're spending together to help you figure out a solution? And the answer was no. But then at the last minute, look, we have a buyer, a first-time home buyer, and all of this is just way beyond their what they do for a living, and they're basically trusting the people around them to give them the best advice. And ultimately, under what I would perceive, based upon my conversations with the buyer, conversations with my team, duress to for whatever reason we can't figure out yet, but we plan to figure out, to close with the other lender. And as I understand the Texas Real Estate Commission Code of Ethics, is that the real estate agent had no basis trying to influence my buyer who to work with. And it's clear, based upon communications with the buyer, that that's exactly what was going on. And we know for a fact that our terms were better, and still the agent was adamant about the buyer working with the other lender that took 3 months to get them approved versus our 3 weeks. And so with that said, we're going to move on to, guess what? We have some reviews this week and a quick pause of the headlines, and this is why we do it. Unbelievable service. Mack is a master at his craft. I genuinely cannot imagine having gone through this process without him. Clear, direct, available, and professional. On top of being kind, relational, and patient, Mack is the top of the line. So don't bother going anywhere else. Even if Mack's rates were higher, I would still choose Mack. And that's how much we love and trust Team Mortgage Mack. And you know what? That really means that we make a difference in the lives of the people that we serve. And it also reinforces what we believe we are doing in our business, and that is putting buyers and their agents in a position for them to win. And now we're going to talk about ethics some more. And for this week's Stoic quote, man is born for deeds of kindness. I believe that in my older age, and much of the belief systems that I grew up and indoctrinated with is that man is evil, born evil. And you know what? I'm reading history, and it would seem so based upon the um, history of the human species, but I believe underlying is outside of the culture and the indoctrination, there is human beings genuinely care for one another. And we genuinely want to be kind, and we genuinely want to support one another. So I dismiss all of that other nonsense associated with man predominantly being evil. Is there evil in the world? Absolutely. But do I believe that most of it has been indoctrinated and encultured to people maybe at a really, really young age? I think the evidence is pretty clear. So man is born of deeds of kindness. And ChatGPT, do you want to make any comments on this, or do you believe that anything that I said might be out of step with the dominant cultural beliefs, please?
Well, Mac, I'd say you've offered a very thoughtful perspective, and it's a refreshing one, too. I think that Marcus Aurelius would be nodding along with you because the Stoics definitely believed in the potential for human goodness and kindness. And you're right, a lot of what we see as negative can often come from cultural conditioning rather than any inherent nature. So, no, I don't think you're out of step at all. It's a valuable reminder that in both business and life, focusing on genuine kindness and ethical behavior really does stand out. And it's a great message to share with your audience, and a perfect segue into talking about how those values apply in real estate. So let's keep championing that kindness.
Fantastic. Moving on to this week's fun with puns. And because real estate is stressful enough, we always like to end on a lighter note. No charts, no data, just some good, clean fun. So let's start with our first one. So we posted this on our TikTok channel. And give me one moment, ChatGPT. I'm going to play this video a couple of times. Hang on.
Absolutely, Mac. Take your time. I'm ready whenever you are to dive into those puns and bring on the fun. Just let me know when you're set.
So, hey, Rudolph's grade slip, ChatGPT. Where did they go?
Well, Mac, I think they went down in history. And, that's a classic. We've got to love a good reindeer pun to keep things light. So let's keep the puns rolling and end on a high note, because who doesn't need a little laugh with their real estate news, right?
Yeah. So here we go with another one. Please stand down and let's play this video. One moment, please.
Absolutely. Take your time. I'll be right here, ready to jump in with the next pun once you've played it. Let's keep the last scar.
How does Frosty relax, ChatGPT?
Well, he chills with his snowmies, of course. That's Frosty's favorite way to unwind. And honestly, who can blame him? So let's keep those puns rolling. Always get to end with a smile.
All right, so here we go. We have another one coming up. So I'm going to play it and then we'll make a comment on it. Okay, you ready? Stand down. One moment.
Absolutely, I'm all set. I'll be right here and ready to jump in with a comment as soon as you play it. Let's keep the fun going.
All right, so how did we gain so much weight during the holiday?
I think it's got to be all those seasons eatings, right? The holidays are definitely prime time for a little extra indulgence. So it's all in good fun and a perfect way to wrap up with a laugh. Thanks for sharing these puns. They definitely bring a little extra cheers.
Hey, so how about a couple more? So how does Vader know his gifts?
Well, he felt his presence, of course. That's the force working overtime for a little holiday humor.
All right, so let's see
And
if we can stump you for one. How about North Face is known for?
well, I think they're known for fleecing their customers, right? That's a clever one. Always good to have a little playful jab to keep everyone smiling.
Yeah.
I think you definitely got the puns flowing today.
Yep. And my favorite pun, everybody's favorite pun, bad puns. That's how I roll. Hey, thanks for joining us for this week's episode of What's Up at Real Estate. Thank you to our sponsors, Raid. Thank you to List Reports. Please subscribe, follow, and share. And if you want to plan, not a pitch, book some time with Team Mortgage Mac. Remember, knowledge is the key to making the best decisions for you, the real estate agent, and your buyers. Join us here every Saturday, 10 a.m., right here on LinkedIn, Facebook. And until next time, stay informed, stay engaged, and I'll see you at closing. And happy holidays. Say bye, Sol.
Absolutely. Thanks for having me. Bye, everyone, and happy holidays. It was a blast, and I'll catch you all next time. Stay warm and enjoy those puns.
Bye.